So, we're live. Good day to everyone who has joined us from all over the world in such large numbers. It seems to be a larger number of people every time. We've got people from the UK, where Aaro Capital is headquartered. We have people from Europe and the Middle East, also from Asia Pacific in quite large numbers, where it's nighttime already, plus some early birds from the Americas. Just to introduce myself, I am Stuart MacDonald, and I am moderating this, the third of the webinars being put out by DLT, or Distributed Ledger Technology, and Cryptoassets investment experts, Aaro Capital. These thought leadership webinars, as some of you know, are available as recordings after the event. The previous two are already in the hands of some of you, but they're on the website. This one will be recorded as well and be available to any of you, and you're welcome to pass it on. Anyway, this increasingly popular thought leadership series of educational webinars is designed for investment professionals to learn more about what is a very interesting and undoubtedly exciting. It's a fast-growing, fast-maturing space, still often misunderstood. And we're going to be looking at the exciting investment opportunities that it presents. It's the case that there is serious money from serious investors, ranging from the likes of Fidelity to Paul Tudor Jones, coming into this space. And Aaro Capital is the first player, to my knowledge, to enter it with a truly and authentically institutional quality multi-manager approach. This approach is very research driven, and this is reflected in their use of academic advisors like Daniele Bianchi of the Department of Economics at Queen Mary University, London. And Daniele will speak of the impact of cryptocurrencies on traditional investment models. And then we'll hear from Peter Habermacher, CEO and one of the founders of Aaro Capital. He will speak about the impact of DLT and cryptoassets on an investment portfolio. Now, as we go through either of the presentations, if you have questions, please put them into the chat room that you will see on the right-hand side of your screen. And we'll do our best to address these. And it's also worth checking out the Aaro website. Aside from what it tells you about their investment-related activity, it contains some very informative white papers and thought leadership pieces that are worth looking into if you want to find out more about the space. Now, without further ado, let's hear from Daniele. Over to you.
Thanks, Stuart, for the introduction. Thanks, Aaro Capital, for having me, and obviously thanks to all of the attendees. So I'm going to talk about, in my half an hour presentation, I'm going to discuss what is the role of the potential role of cryptocurrencies within the context of traditional investment models. I'm Daniele Bianchi, and I'm from the School of Economics and Finance at Queen Mary University of London. So it goes without saying that there's been a lot of interest in digital assets over the last few months and years, and this is reflected in the creation of thousands of different digital assets and cryptocurrencies. So it's a rapidly evolving market. Now, nevertheless, the investment properties of digital assets at large are yet to be fully understood. From the perspective of a portfolio managers, indeed, there are two key questions that are, largely still unanswered. The first one is, are cryptocurrency effectively segmented from more traditional asset classes? And ultimately, what is the risk-return trade-off on investing in digital assets in the first place? The implication of digital assets being separated, being segmented, is non-trivial from an investment perspective. And the main idea is that if, in fact, digital assets are separated from traditional asset classes, they might be, they may offer, in fact, considerable and persistent diversification benefits, right? And the idea is, in fact, that they can give investor protection against different shocks. Like, for instance, there has been a lot of talk over the last few months of Bitcoin being potential and hedge for inflation shocks, or even the simple investment in DLT technology could be a hedge for technological shocks. If you think about DLT as disrupting traditional financial markets, for instance. That's the case, for instance, of the decentralized finance applications. So a typical way to look at diversification properties within the context of a standard investment model is to look at the correlation between returns, or correlation between volatilities, or correlation between high order moments like crash risk, for instance. When I say correlation here, I mean correlation between digital assets and more traditional asset classes. Now, the way I'm going to tackle this question is through a simple, standard multi-asset investment framework with the addition of a value-weighted portfolio of digital assets. So the idea here is to have a standard asset menu. And in addition to the standard asset menu, I'm going to consider a value-weighted portfolio of digital assets as additional type of investment. Now, before getting there, let me show you a couple of graphs. And in particular, let me show you what I mean with segmentation between cryptocurrency and traditional assets. So what I'm showing here is the correlation between the value-weighted index of cryptocurrencies and a variety of standard traditional asset classes. The blue line here is the stock market, so the Vanguard Global Stock Index Fund. The red line is a bond index for government bonds. The yellow one is the Standard & Poor's Goldman Sachs Commodity Index, and the violet one is a proxy for the real estate market. And what I'm plotting here is the 1 year correlation based on 1 year returns. And as you can see, correlation has been pretty low throughout the sample, with the only exception of the last couple of months for the COVID-19 crash. I'm going to go back to this point later on during the presentation. So overall, this picture tells you there has been, in fact, low correlation between crypto and traditional asset classes in terms of returns. Now, there has been low correlation also in terms of volatility. What I'm plotting here is, again, the volatility based on 1 year returns in percentages daily for different traditional asset classes, and the value-weighted portfolio of cryptocurrencies, which is the green line now. Now, as you can see, volatility for traditional assets has been relatively low, with the only exception of the recent few months, while for, and obviously, as everybody knows, the volatility in the cryptocurrency space is much higher. And in fact, it's sort of decoupled. The dynamics of volatility in the cryptocurrency space is sort of decoupled with respect to standard traditional asset classes, with the only exception, again, of the last period, the last couple of months during the COVID-19. Now, if you go further to the second moment, so volatility, and you look at crash risk, again, you see that, in fact, there hasn't been too much correlation between cryptocurrency and other assets. Again, what I'm plotting here is a measure of skewness, so probability of losses, using 1 year of data of traditional asset classes with respect to the value-weighted portfolio index, which is, again, the green line. And as you can see, that if anything, cryptos, they tend to have, in fact, positive skewness for a large fraction of the sample. And if you look at the crash during the COVID-19 period, the crash has been much lower than, for instance, government bond and real estate market, which is respectively the red line and the violet line. So all in all, it seems that there is strong evidence, or strong empirical evidence, so to speak, that digital assets are segmented, meaning uncorrelated, not only in terms of returns, but also volatility and crashes from traditional asset classes. Now, the key thing here is that, however, market segmentation, so absence of correlation, does not necessarily translate in financial gains, right? So you have to do the extra mile and try to understand if, in fact, using cryptocurrencies or digital assets more generally helps you to make better investment decisions. So it helps you in trading, portfolio allocation, and risk management. So the key question here, again, the key question that I'm after here in this 20 minutes talk is, can we exploit crypto segmentation to effectively improve our investment decision in terms of risk-adjusted return, so the risk-return trade-off ultimately. So when I talk about the risk-adjusted returns, what I really mean here is the Sharpe ratio. So what I'm showing here is the Sharpe ratio based on 1-year returns of, again, the evaluated index of cryptocurrencies against a variety of traditional asset classes. Again, the green line is the cryptos, the blue line is the stock market, the red line is the government bond index, yellow line is the commodity index, and violet one is the real estate. And as you can see, for a large fraction of the sample, the Sharpe ratio, so returns per unit of risk that is realized by cryptocurrency is much higher than traditional asset classes. When I say much higher, keep in mind that these are daily estimates. So for instance, if you see in January 2018, the Sharpe ratio of crypto was above 0.25 on a daily basis, against, for instance, the stock market that was slightly below 0.2, again, on a daily basis. With the only exception of the period from January 2019 on, and I'm going to go back to this point later on, but at the end of the day, you can see that it seems that not only cryptocurrencies are sort of uncorrelated in terms of returns, volatility, and crash risk, but they also deliver better risk-adjusted returns, right? Now, that's taken singularly, but at the end of the day, what as an investor, what people could be interested in is, okay, how this translate in investment models. So how can I exploit not only in correlation, but the fact that crypto can give me better risk-adjusted returns within the context of a multi-asset portfolio. So the way I'm going to investigate this aspect is through 2 alternative investment models. So I'm going to use a top-down approach, what I call a top-down approach. So the idea is that you have a pre-established investment model, and then you add a value-weighted investment in crypto. For instance, think about a 50-50 equity bond portfolio or a multi-asset balance. And then the idea is that, okay, you slightly introduce more and more investment in crypto, and you see how the risk return profile of your portfolio changes. Then there is a second approach you can think of, which is more of a bottom-up approach. So I'm not going to consider any pre-established investment model. I just make an assumption about, the kind of, utility that my investor, representative investor, may have in mind. And after that, I let the data speak. So I don't assume any investment model in particular. I let the data speak and tell me how the portfolio composition should look like and how the portfolio performance would be, consequently, in terms of risk-adjusted returns. So, related to the first exercise that I'm going to do, this top-down approach, I'm going to consider specifically 3 different investment models. So a first model that I call, that is widely known as Norway model, so a simple 50-50 equity bond portfolio. Second model, which is less conservative, so more aggressive. If you think about, that could be a less risk-averse investor, so more tilted to equity, so a 80-20 equity bond portfolio. And then finally, a more, if you think less simplistic and a bit more realistic, portfolio allocation setting, whereby I have 40% in equity, 30% in government bonds, 2.5% in commodity and real estate, and 5% in cash. Now, to these 3 alternative portfolios that I call reference portfolios, I'm going to include 1%, 3%, and 5% investment in a value-weighted portfolio, which includes the top 30 digital assets out there currently traded that are selected by market capitalization, right? And I'm going to report a set of unconditional and conditional statistics, such as return and volatility and risk-adjusted returns. So here's the results. So the first table shows you the unconditional average returns. The first column under reference is the average returns in percentages annualized you're going to get out of the portfolios without crypto. And then as you move from the left to the right of the table, you see how the unconditional average returns are going to look like if you increase the proportion of investment in crypto. So 1%, 3%, 5%. You see that there is a pretty, homogeneous path here, in the sense that as soon as you include your fraction of investment in crypto, then you have more, higher returns at the end. So for instance, with a 5% in crypto in a 50-50 investment model, you're going to have a bit more than 6% annualized rather than 2.3% annualized. Now, the fact that you have higher returns could come, in fact, it comes with a higher volatility. So a better picture could be given by looking at the risk-adjusted return, so the Sharpe ratio. And again, everything is the same. So first column under reference is the standard investment models without crypto, and then from the left to the right, you see what happens if you include crypto. And at the end of the day, it's not only that you get higher returns, average returns, but you also get higher risk-adjusted returns. For instance, you get an annualized 0.52 Sharpe ratio in a 50-50 investment model if you have 5% investment in crypto rather than a 0.2 Sharpe ratio if you don't invest any of your money in it. Now, this is unconditional. So as I said before, I'm going to look at also a conditional measure. So what I'm plotting here is the conditional Sharpe ratio. So it's the Sharpe ratio calculated using 1 year of data. So it's basically 1 year average returns over 1 year standard deviation on a rolling window basis. And again, the picture is pretty clear. Here is the 50-50 equity bond portfolio. So you see the reference Sharpe ratio, which is the blue line. And then you see how you gradually improve the conditional Sharpe ratio if you include a bit more of crypto investments. And for instance, you see the dashed violet line, which gives you in January 28 a much higher annualized Sharpe ratio. Same thing if you look at a more aggressive 80-20 equity bond portfolio. If you include if you include some investment in crypto, it seems that the risk-adjusted returns are higher, and similar picture you're gonna get if you invest in a more balanced portfolio whereby you have not only equity and bond, but you also have commodity and real estate. So that was the first example. Now, one could argue that, okay, what happens if I just let the data speak and I take a more data-driven approach whereby, I really want to disentangle what is the pros and cons of digital assets in terms of optimal fraction of investment that I want to give, that I want to assign to each of the asset classes. So the objective that I have in mind here, consistently with the picture that I showed you before, is to maximize the Sharpe ratio. And to do that, I'm going to assume that my representative investor has mean variance preferences. So there is this trade-off between maximizing returns and minimizing risk. And the idea here is to find the so-called tangency portfolio. So the question is always the same: do cryptocurrency improve standard mean variance portfolio allocation? So here's the first piece of evidence. So what I'm plotting here is the risk-return trade-off of single asset classes. On the x-axis, you see portfolio risk in percentages annualized. On the y-axis, you have the portfolio return. The blue labels are the single asset classes, so government bond, equity, real estate, and commodity. In black, you see portfolio without cryptos. So that's the basically the risk-return trade-off you're going to get investing in a portfolio without crypto. While in red, I'm going to highlight the risk-return trade-off if you have a portfolio with crypto. So as you can see, with a slightly higher risk, because if you see on the x-axis, the risk is higher, comes a slightly higher portfolio returns, which ultimately translate in a higher Sharpe ratio. So what I'm showing in this figure here is the Sharpe ratio version of the figure that I showed you before, so the two axes. Again, from the left to the right, in the first four column, I have the traditional asset classes. The last two is portfolio with cryptos and portfolio without cryptos. And as you can see, if you are completely agnostic about the weights, and if you include a fraction of cryptos in your investments, you're going to get almost 50% higher, in fact, Sharpe ratio. So almost 1.5 against 1. Now, as a sort of a robustness here, I'm going to consider also, okay, what happens if you sort of constrain yourself to have a fully diversified portfolio? Because in the exercise, so in this picture that I showed you before, it turns out that you're not going to make any investment in commodity and real estate, but you all invest in equity and government bond because those gives you negative Sharpe ratio. So what happens if I force myself to invest in those assets anyway? So again, I just want you to focus on the black label, so portfolio without cryptos, and the red one. And as you can see now, the volatility is much higher. but the portfolio returns are much higher either. So in fact, much higher than before, actually almost four times higher, which again translate in a Sharpe ratio that in comparison is there is basically almost no contest if you have a portfolio with and without cryptos. You see that portfolio with cryptos gives you a slightly higher Sharpe ratio than 1, while a portfolio without cryptos gives you a Sharpe ratio that is slightly below 0.4. So I just want to finish this, my slot, basically give you a word of caution though, because it seems that, okay, it's all nice and smooth when it comes to cryptocurrency investments, but at the end of the day, that's not necessarily the case. So what I'm showing you here on the left panel is the rolling 1-year volatility of a portfolio with cryptos, which is the blue line, versus a portfolio without cryptos, which is the red line. And as you can see, volatility of your portfolio, once you include cryptocurrencies in your investment menu, volatility increase quite substantially. If you look at, for instance, throughout 2018 and 2019, volatility is more than double. And that translates on the right panel of the picture, that translates in a Sharpe ratio, which is not necessarily always higher than traditional investment. Again, you see that the conditional Sharpe ratio is much higher, basically throughout until January 2019, but afterwards it's comparable. This is for the unconstrained portfolio, so a situation where I'm not constraining myself in any way in terms of weights. This is for the constrained portfolio, where things gets a bit closer because the constraints on our portfolio, they have some sort of normalization effect. But at the end of the day, the picture is the same. So the word of caution here that I want to have is basically that you have to be careful in two things. First one is when you invest in crypto, you have to be prepared in facing high volatility. And the second message that I want to put out there is that you have to be also careful in the way you select those cryptocurrencies because you want to invest in, because at the end of the day, what I'm considering here, it's a very simplistic, value-weighted portfolio of the top 30 cryptocurrencies. It might well be the case that if I'm more careful in selecting my cryptocurrencies, my digital assets in a bit more complex way or more professional way, if you wish, I might actually end up to do even better than I'm doing now, right? So those are the two things you have to be really careful. Be prepared in facing volatility and be careful in the way you select your crypto investment. So the last few minutes that I have, I just want to highlight some of the reference literature that there is out there. I contributed actively to this literature. I'm highlighting here 3 papers. The first one, it's a working paper that I have with some co-authors at Bocconi University, and basically this gives the backbone of the slides that I just showed you. So the fact that there is a correlation and segmentation between cryptocurrencies and traditional asset classes. The second one is forthcoming on the Journal of Alternative Investment, and basically in that paper I show that cryptocurrencies are not necessarily affected by macroeconomic variables. And the last paper that I'm highlighting in this slide, it's an interesting paper by people at the National Bureau of Economic Research, where they basically show again that there is some sort of uncorrelation between risk and return in cryptocurrencies versus traditional asset classes. And again, this is some other paper you may probably want to have a look at. All of those are basically the backbone of what I've been discussing over the last 20 minutes. So the takeaway here is, okay, there is widespread evidence that digital assets are separated from more traditional asset classes, and intuitively this may generate considerable and persistent diversification benefits, at least when it comes to a standard investment model. However, you have to be careful in what kind of crypto investments you make and the optimal weight you're going to assign to crypto within the context of your investment model, right? And the last thing that I want to mention here is that when it comes to correlation, the recent COVID-19 crash showed that there has been some increase in the correlation between crypto and traditional asset classes. But what I personally think is that this is just a transitory shock, which is basically due to flight to cash, and it's not going to be in the pricing mechanism of cryptocurrency to be correlated with traditional asset classes, right? So thanks for your attention.
Look, Daniele, that's brilliant. It's Stuart McDonald here again. some really interesting points. A couple of interesting questions have come up as well. I think that you made a pretty powerful point insofar as it's quite clear that in this space, to mediate one's own desire to invest in it, one might do well to go through people who know this at a fine level of detail. They do it full time. I suppose that is Aaro's proposition in the end. But a couple of questions have come up on the screen. One of them is really about how you've put this together. Why have you, this is from CG, why have you used a value-weighted investment in the top 30 cryptocurrencies by market cap? It doesn't seem to make sense to CG. And Andrew Hard is asking, what is the investment horizon you have in mind in your exercise, and what would you see as the optimal investment horizon? Do address either or both of those in the next 2 or 3 minutes. There is a question hanging over this as well, in any case, and if you have time, address it now, maybe at the end, which is that the work that you and others have been doing has indicated that there are investment benefits at a portfolio level from making relatively small allocations to this space. At one point, what would be your cutoff point? At what point does that become suboptimal? Why don't you put everything into this if the benefits are there? Over to you and your choice of which of these to address.
Yeah, I can address all of those, in fact. So regarding the first question by CG, the reason why I use the value-weighted investment in the top 30 cryptos because this is representative at the end of the market trend. So in fact, if you look at the correlation between the value-weighted index that I'm using and, for instance, Bitcoin, which is the dominant player, in fact, has about 70% of the market capitalization, they are highly correlated. So the reason why I took the largest one is just to capture the market trend at the end. Obviously, as I said, if you are more considerate in the way you select your crypto investment, you could do better. What I wanted to do here is really just to capture the market trend in a simplistic way, something that everybody could do effectively. That's the reason why I use the top 30 cryptocurrency by market cap. Now, regarding the question of what is the investment horizon, I think this is really interesting. And for some reason, everybody focuses on short-term investment properties of cryptocurrencies, while in fact, the nature on itself of blockchain technology should lead you to look at the long-term horizons, right? So to look at the long-term investment, so the long-term benefit in terms of diversification or hedging different type of shocks. So what we should probably start to look at from now on is to the long-term investment properties rather than the short-term. So the investment horizon that I have in mind in this exercise and what everybody has in mind at the end is a very short one, but perhaps it's about time to look at the long-term one as well. So this is definitely a good point. And now regarding the optimal cutoff, well, I think that's really depends on what is your risk aversion, because as I said, with high returns comes high volatility, and it could be relatively easy to wipe out all of your wealth in days, basically, if you put all of your wealth in cryptocurrency. So the proposition that I have here is that it's not necessarily a wise idea, even though the data may suggest that it's a wise idea, not necessarily a wise idea to put all of your wealth in cryptocurrencies, but keep a balanced approach whereby you have a more diversified and balanced portfolio across asset classes, for instance.
Well, I think that's an important point, Daniele, because however attractive the returns may appear to be in any given area, in any given asset class, to put all of your eggs into that one particular basket can leave you very exposed. But really what you're saying bears out taking a diversified, perhaps multi-manager, multi-strategy approach to this area in particular, which to many of us is quite reminiscent in its evolution at this stage to the way that hedge funds were for a long period, where the most effective way of gaining a sensible exposure to the returns that were available was through funds of funds or multi-manager portfolios, rather than trying to pick off individual component parts oneself. Anyway, this is all very good stuff. And I think we will move on to our second speaker, Peter Habermacher. And just in introducing Peter, I have to thank Peter and his colleagues for being quite instrumental in changing the view I had of this space. Like a lot of people, I thought that blockchain was just a database and that crypto is nothing more than a slice of the Wild West, inhabited by whales and teenagers. And as the space matures, as I mentioned before, it's quite clear that we're now getting quite serious institutional investors coming in, and the trading and other infrastructure is coming together. And I would simply say, if you want to take advantage of the investment opportunities while controlling risk and also grabbing the diversification benefits that it offers, you probably do need an institutional quality approach. And this is where Aaro Capital's particular approach is quite interesting. Let's go over to you, Peter. Let me just remind everyone that if you have questions, please put them into the chat room that's on your screen. Over to you now, Peter.
Thank you, Stuart. So hello, everyone. My name is Peter Habermacher, and I am delighted to be the Chief Executive of Aaro Capital. In this presentation, I'm going to be expanding upon the impact that the DLT and the cryptoasset growth story has on a typical investment portfolio. So Daniele has shown via quantitative analysis that there are potential portfolio benefits from DLT and cryptoassets. However, there also needs to be qualitative support before undertaking any investments. I'll be discussing the key considerations we have when constructing and managing a portfolio in the DLT and the cryptoasset space to ensure that we maximize the diversification benefits and the positive impact we have on our investors' portfolios. The key message of this presentation is qualitative understanding and tools need to be the driving force behind any investment in this space, with quantitative analysis being used as a supporting screening tool, a sense check, and a tool for sizing positions. Firstly, I will quickly recap the key considerations for effective portfolio management and construction. I will then discuss the DLT and the crypto-specific considerations when constructing a portfolio in this space and how we have adapted the portfolio manager toolkit to optimize it for this unique asset class. I will then provide an overview of the investment landscape and the breadth of the opportunities available, alongside the market's defining features relative to traditional asset classes. Finally, I will analyze the different entry points and how these affect and impact a portfolio and its key performance metrics. As an investor, the core focus always needs to be on the portfolio's core investment aims. This is done by optimizing the key performance metrics such as annualized return, Sharpe ratio, Sortino ratio, or maximum drawdown. From modern portfolio theory, the aim of any portfolio is to maximize return for a given level of risk, more specifically downside risk. The aim is to always get as close as possible to the efficient portfolio frontier, where one is maximizing return for the level of downside risk we as an investor are willing to take. There is a key decision when constructing a portfolio, the level of active management to take. However, there's an important trade-off here. Namely, the more actively managed a portfolio is, the more alpha generation is possible and the closer we can get to the efficient portfolio frontier. However, if done incorrectly, greatly increases the likelihood of underperformance or excessive risk-taking. The practical constraint on how actively managed a portfolio is the available time, resources, and expertise. To do active management effectively requires a lot of time and it is very expensive. Further, the investment horizon of a portfolio is a key consideration. Finally, the key to effective portfolio management is understanding how each allocation works together to achieve the investment aims. It's not just about maximizing the Sharpe ratio or other performance metric. So moving on to portfolio implementation, there are three common approaches to portfolio implementation: the core approach, the core and satellite approach, and the building blocks approach. The core approach cheap and straightforward to implement and monitor. This should always be the go-to approach in markets where one has limited expertise. However, this approach forgoes potential alpha. The core and satellite approach is one where one is able to enhance core portfolio positions with niche opportunities. However, this requires more time, more resources, and expertise. In the building blocks approach, one has full flexibility of a portfolio construction and the ability to fully express one's investment views. There's potential for large alpha generation. However, it is complex, it requires time, it requires resources, and it is expensive. For this reason, it results in underperformance and excessive levels of risk for many investors who take this route. We use the building blocks approach to be able to fully utilize an in-depth understanding of this technology and this asset class. This enables us to effectively manage risk while still being able to capture more of the upside in bull markets. So moving on to the DLT and crypto-specific considerations. Diversifying into a new asset class can bring diversification benefits to a portfolio, but also presents potential challenges. Many investors expanding in this new asset class into a new asset class commit the cardinal error of relying excessively on past performance to optimize portfolio allocations. In contrast, the most successful investors focus on future expected returns. Making the most of each asset class requires significantly different approaches. For example, the most effective investment strategies in investment grade bonds is very different to the most successful in emerging market equities. Investors should always seek to develop and adopt the investment philosophy which maximizes the portfolio benefits of any new asset class. The DLT and the crypto asset class is truly unique, therefore requires a bespoke investment approach. Many investors who enter it, however, cling to the favored investment strategies without discovering it is genuinely the best approach. Sensible investors should always gain a broad understanding before making meaningful allocations in this space. The key characteristic of this market is that it is an early stage market, which is very different to mature traditional markets. This has several key implications. First, the length of performance data is short, both for underlying assets and asset managers. This limits the type of quantitative analysis we can undertake and the weight we can place on the results. Being an emerging market, its characteristics are also constantly evolving as it matures. This evolution changes how the market behaves and therefore needs to be taken into consideration when using quantitative analysis to aid with investment decisions. An example of this market evolution is the development of professional asset management infrastructure over the past few years. The crypto market infrastructure covers all the traditional market components from brokerage to clearing and settlement, alongside new crypto asset custody solutions. Alongside crypto specialists, companies like Fidelity Digital Assets provide crypto custody and brokerage services. There is also Backed, an intercontinental exchange company. Another example of market evolution is the top-tier institutions who have now entered this space and who have altered the investment mix in this market. Given the importance of these changes in the market evolution, a thoroughly researched base case and a more venture capital mindset is required relative to mature markets. Also, the market is characterized by continual bubbles and bursts, which is important, which kind of impacts the results of quantitative analysis. Liquidity is also a key consideration, given the size and the volatility of this market. Most quantitative risk measures do not consider liquidity risk and so do not fully reflect the investment risk in a crypto portfolio. The core message is qualitative understanding needs to be the driving force behind investment decisions in this space, with quantitative analysis used as supporting screening tools, a sense check, and a tool for sizing positions. One of the most important considerations for crypto investing is that operational due diligence is equally as important as investment due diligence. We undertake both investment and operational analysis side by side from the very start of an investment process. This is in strong contrast to most traditional asset managers, where operational due diligence is more of a tick box exercise at the end of an investment process and is almost an afterthought. There are several key drivers behind the importance of operational considerations. Firstly, the market is dominated by startup managers who are operationally weaker than established asset managers. For example, less than half of crypto managers have an independent director, and around 20% of managers still do not have an independent custodian. Further, due to the new and unique nature of crypto assets, there's still operational risks which have not yet been fully managed and mitigated by asset managers. For example, valuation is still an area with no standardized practices, where prices can vary significantly between different exchanges, or custody, where insurers are still working to understand the key risks of the custody process for crypto assets. Further, large operational risks occur infrequently, so short track records do not show the impact of these on performance. These events also can lead to funds to shut down, so there is a survivorship bias if you only look at present funds. In such a new and exciting space, it is easy to lose focus and get distracted by the shiny technology. Economics is required to make sense of such a complex and a quickly evolving investment landscape. The focus always needs to be on the fundamental economics problems being solved. From this, we can identify the sectors and the use cases where the technology will generate the most value. McKinsey have identified over 80 use cases across 14 industries, including finance, insurance, healthcare, supply chains, and digital identity. However, where the technology is applied differs from where the profits will be generated as a result. Long-term profit generation is largely determined by the competitive landscape at different stages of the value chain. For example, European markets, where markets are more efficient, early movers can quickly capture large market shares, but big bank consortiums will face competitive pressures to pass on DLT-related cost savings to its customers. In less efficient Asian markets, however, incumbents applying this technology will face less competitive pressures to pass on cost savings. The final consideration is the timing of these profits. Adoption and implementation of technology takes time, and many DLT applications will take years of R&D and investment before profits can be realized. The lucrative profit generation centers will dissipate over time as the technology and its implementations evolve, while new profit generation centers will come on. To be able to fully take advantage of this, we need to be able to identify the profit centers before the rest of the market start chasing them. For this economic analysis, we stick with the tried and tested neoclassical economic school, which has dominated economics for the past 40 years. We have invested a lot of time in building up our economic framework to ensure a robust economic support for this growth story over the long term. Alongside our 4 economic white papers, we've also published over 35 articles on the economics of DLT and crypto assets as part of our thought leadership series on our website. So moving on to the opportunity set. The key characteristic of the DLT and the crypto asset investment landscape is the information asymmetries and the significant opportunities for knowledgeable investors in the form of inefficient markets. Given the inefficient markets, the potential for outsized risk-adjusted returns from effective asset management is a size of magnitude larger than in traditional asset classes. The potential returns from effective asset management becomes apparent when comparing the performance of crypto funds relative to passive benchmarks. As a working paper by Daniele found, active managers kind of outperformed an Bitcoin by 350% over a 5-year period. However, there's a large dispersion in the performance between crypto managers. For example, Daniele's paper found that only a small subset of funds can outperform passive benchmarks and produce large, economically significant alphas. Importantly, for active managers, for active investors, the paper also shows that manager relative performance is persistent over time. Crypto manager performance is not mean reverting, and so manager selection can lead to outperformance of the portfolio. We split the strategy landscape into 4 macro buckets based on the return profiles of different strategies. These buckets are market neutral, long short, opportunistic, and long term. The market neutral strategy bucket is predominantly quantitative arbitrage. However, there are also good longer term arbitrage opportunities, such as lending crypto assets to crypto exchange traded products, which typically trade at a premium to their underlying assets. The long-term bucket, the long-short bucket, is predominantly quantitative strategies as well, alongside fundamental long-short managers who trade over longer time periods with risk-managed market directionality. Opportunistic strategies is an interesting strategy bucket, with strategy returns which are largely idiosyncratic to the market, creating large diversification benefits. The long-term bucket is made up of long-term thesis-driven strategies, such as thesis-driven hedge funds, venture capital, or private equity. This bucket includes UCITS mutual funds, buying the shares of public companies expected to generate and sustain high profits from this technology. Our investment landscape covers the full opportunity set, everything from 2-page white papers to initial coin offerings, to arbitrage hedge funds to mutual funds buying big bank stocks who are applying this technology. On the investment funds landscape, alongside the traditional fund structures, there are also hybrid funds which provide access to VC-style investments through open-ended hedge fund structures. A key aim of DLT and crypto is open finance, allowing for great access to investment opportunities and also to improve the secondary markets for venture and private equity investments. It is these developments which allow for the shorter time horizons of these hybrid funds relative to traditional VC. The investment universe also includes UCITS mutual funds, who gain exposure to sectors and the companies we expect to generate sustained profits from this technology and this asset class. On the underlying assets, alongside many types of crypto assets, we gain exposure to idiosyncratic market opportunities such as mining and staking activities, where participants of Bitcoin and other cryptocurrencies generate revenue from the network. So moving on to the impact on a portfolio. Similar to Daniele's analysis, on this slide we show the impact of adding a crypto market index allocation to a portfolio comprising of 50% equities and 50% corporate bonds. As Daniele outlined earlier, adding a 5% allocation has a big impact on return, more than tripling annualized returns. However, the level of investment risk in the portfolio also increases. Nonetheless, the portfolio's risk-adjusted performance measures such as Sharpe ratio and Sortino ratio more than double. On this slide, we show the impacts of investing in crypto funds. On the first 2 rows of the table, we see the performance of the crypto market index relative to the crypto fund index. While the annualized return of both are similar, the crypto fund index has less than half the risk associated with it, leading to superior Sharpe and Sortino ratios. On the final 2 rows of the table, we compare the effect of having a 5% allocation to the crypto fund index relative to a 5% allocation to the crypto market index. We see that an allocation to the crypto fund index more than doubles the annualized return of a portfolio, although this is lower than for the crypto market index. However, while the crypto market index notably increases portfolio volatility, the crypto fund index has a limited impact on portfolio risk. It even slightly decreases the maximum drawdown. The Sharpe and Sortino ratio measures, the measure of risk-adjusted return, are very similar between the 2 portfolios. This slide shows that crypto funds can be a more appropriate access route into the crypto growth story for more risk-conscious investors. I've now left some time to answer any questions the audience might have.
Peter, that's great. Just before we go to questions, and actually I'm going to put the first question to Daniele and then come over to you, Peter, if that's okay. Just to let people know that if they've enjoyed this particular webinar, it's the third in our series. The previous two recordings are available via the Aaro Capital website, as are the white papers that Peter referred to. And if you want to find out more about what Aaro's doing, obviously they will be pleased to hear from you. And there are more white papers in the pipeline. There's also a fourth webinar that's already scheduled for October the 1st. And that's about a very interesting topic to me, the future of digital money and its role in the fourth industrial revolution. That should give us a lot of food for thought. So that's on the 1st of October. Also, Aaro, I'm aware, are going to be at a couple of conferences on the 16th of this month at the WLTH conference, and also on the 28th of October, Peter will be speaking at the Game conference, which is online this year. I have the privilege of chairing both days of that, the 27th and 28th. It's probably worth attending online. We've had some really interesting questions through. This gives me an excuse to say hello to a friend of mine over in New York, Jasmine. Hope you're doing well, and I'll be in touch with you separately. I'm actually going to put this one to Daniele and then switch over to Peter. You can see on screen a question about efficient frontier and average correlations, and what are the crisis correlations? And does this assist or add to tail risk in portfolios? Daniele, do you want to pick this one up?
Yeah, I'd love to do that. Can you hear me?
Yes.
Okay. Yes. So there is some research, and in fact, we have done some work exactly for that question. That when it comes to tail risk, so when it comes to crashes, there is very low correlation between crypto, Bitcoin, for instance, in particular, but cryptocurrencies more generally, and the aggregate, the traditional asset classes. The only exception to that absence of correlation was during the COVID-19 crisis, where basically you can think about a common factor that dragged down all of the asset classes, Bitcoin included. In fact, there has been the big crashes on March 12th, the so-called Black Thursday on the cryptocurrency market more generally. So in general, there is low correlation when it comes to tail risk. And if you put together cryptocurrencies and traditional asset classes, you see that when it comes to tail risk, the picture does not change as much. In fact, it's likely improved with cryptocurrencies because on average, unconditional at least, cryptocurrencies has a positive skewness versus other asset classes that have a negative skewness. So there is some sort of netting effect between the two. So long story short, the evidence shows that when it comes to tail risk, they are not, Bitcoin and cryptocurrencies, they're not much correlated with traditional asset classes. And in fact, they may have some mitigation effect. Again, that's depend on the type of investment you make in crypto. So it might be the case that this is not true across the board for every cryptocurrencies out there and for every fund you invest out there. There might be exceptions, but at least what I've seen in the data so far points toward a direction of some sort of mitigation of crash risk, including crypto in a traditional portfolio context. Okay, that's really good. Peter may have something to add to that, but Andrew Hard has asked another question. But before that, I'd like to add a very general, an almost catch-all question, which in the end is underlying any questions we have about this space and what Aaro are doing, given that they've adopted a multi-manager, multi-strategy sort of approach, very broad one, that's trying to capture what's happening in the DLT space as well as crypto assets. Peter, very simple question, but a complex one. Why invest in funds instead of, why invest in a fund of funds instead of just going in directly? So yeah, this is a kind of important question, and there's
many pros and cons of kind of each access route, as covered in our previous webinar. The key constraint is time, kind of resources and expertise. Direct investment is kind of very expensive and kind of very resource intensive to do in a risk managed way, and kind of limitations on resources may kind of make direct investors or other kind of direct fund investors underperform the market or take excessive levels of risk to achieve returns. Many kind of fail to kind of even realize the level of risk they're taking due to a lack of kind of risk management and monitoring. For example, kind of what we've seen in our underlying manager research is to do direct active investment properly in this space, it costs $1 million+ to construct a portfolio, and then at least $500,000+ to kind of manage it on an annual basis. Otherwise, you're just taking needless risk or missing out on good opportunities which are in this space.
Okay, it's really interesting. Just an observation of my own is that from my own exposure over the years to hedge funds, this space is still at a stage where operational due diligence, which is often the orphan or the inconvenient cousin of investment due diligence, as far as some hedge fund investors are concerned, is triply important in this space. For example, you have more and more decent custody available and used by managers, but still there are quite significant numbers that don't have those kind of arrangements in place. And you really do have to look at the underlying viability of the managers. So operational due diligence is pretty important, as well as investment due diligence. If you don't have the facility to do that, you could be just throwing your money away. Andrew is very insistent. Andrew Hard has asked a couple of questions. Let's just ask, why not just go for quantitative market neutral strategies and save on all the work understanding the economics of the space?
So as a core allocation approach where kind of you have limited kind of time to kind of manage it, like it may be an option. However, there's kind of, as we're discussing, still the hidden operational risks, which are still a key issue and requires time to understand and manage properly. Kind of further, there are much greater kind of portfolio diversification benefits from including many different DLT and crypto strategies, and kind of it helps you get closer to the efficient portfolio frontier than just add one particular type of exposure, one kind of crypto specific strategy to your portfolio.
Okay, we don't have that much time left, but we can maybe just deal with this other question from Andrew. What are the economic benefits of crypto assets, which at least to him appears to be just a very speculative space?
So firstly, kind of cryptocurrencies like Bitcoin, like as we've seen, do provide portfolio diversification benefits, and this can be seen as kind of a service, similar to the way kind of gold is used to diversify a portfolio. So there's clearly value here. Second, as covered in our last webinar, cryptocurrencies are central to the core value proposition of DLT and blockchain, and that is decentralization. This, one needs to kind of bear in mind that this is still kind of an experimental early stage technology, as the internet was in the early 1990s. But when the infrastructure matures and it becomes more user friendly, the economic value generation is very clear.
Okay, I think that that gets us to a point where we can just about wrap this up. Thanks to all of you who've attended this, our third Thought Leadership webinar. Again, the next one's going to be on October the 1st. Please sign up for it. Apologies to those of you who had difficulties because LinkedIn was not taking on board people's registrations and they had to register separately. Again, if you want to have a recording of any of our past webinars, this one will be sent to you in any case. Please go to the Aaro website. Also, it's really worth looking at the papers they've got there. And by all means, get in touch with them via their investor relations address should you have product related inquiries, but that's up to you. You know, it's been really interesting, and so I thank our speakers. I wish you all a good and prosperous day and week and month, and yeah, till the next time. Thank you, everyone. Thank you, Peter, and thank you, Daniele.
Thanks.
Thank you. Bye-bye.
Thanks.